Welcome to the deep dive. Today, we're looking at something a little different. It's not just a collection of articles, but a full content framework, a whole curriculum, really.
A roadmap, almost.
Exactly, a roadmap for getting your head around personal finance. Our mission today is to unpack that structure, and we're going to focus on one part in particular, how to teach these skills early on.
Which is so critical.
Okay, so let's get into it. The sources break down mastering money into 7 big categories. It starts with the absolute basics and then builds up to, actual wealth building habits.
A very deliberate sequence.
Right. So we're going to map out that framework, but then we're really going to zoom in on the age-by-age blueprint for teaching kids about money.
And that's because the sources make a really strong point that most adults struggle because they're forced to learn this stuff when the stakes are already sky high.
And you're trying to figure out debt while you're already in debt.
Precisely. And if we connect this to the bigger picture, you can see why this kind of structure is so needed. I mean, financial education in schools is, well, it's rarely handled well, if at all.
Basically non-existent.
Right. So we end up forming our habits by just watching the adults around us. How they spend, how they worry about money, or maybe how they avoid the topic altogether.
So the goal of this whole framework is to make those big future decisions feel familiar.
Familiar instead of intimidating. That's the whole game. That familiarity is a kind of psychological armor against making really costly mistakes out of confusion.
So let's look at this structure. The sources lay out these 7 segments, and what really stood out to me was the first one. I expected, budgeting to be number 1.
Me too.
But category 1 is money basics and financial psychology. Why start with mindset?
That's a great question, and it's so important. The sources basically argue that if you don't tackle the psychological side of it first, the shame, the anxiety, the impulse buys, none of the other stuff, none of the practical advice will actually stick.
So it's about behavior first, mechanics second.
It's almost 80% behavior, 20% mechanics. You have to start with the 80%. This first part forces you to look at your own mindset and clear up those beginner misconceptions that just lead to, paralysis.
Okay, that makes a lot of sense. So once you've addressed the behavior, then you can move on to the systems. Category 2 is budgeting and saving strategies.
The practical tools.
Right. And they highlight all the popular ones. You've got zero-based budgeting.
Which, if you haven't heard of it, just means every single dollar you earn gets a specific job.
And then the classic 50-30-20 rule for needs, wants, and savings, and even the old-school envelope method.
And the point isn't that one is better than the other. It's that you need a system to automate that trade-off between you now and you in the future.
Right. So if budgeting is your offense, then category 3, credit, debt, and responsible borrowing, that's your defense.
A crucial defense. This is where most beginners get into trouble, and fast. The sources really dig into how credit scores actually work, the common traps.
Like just making minimum payments forever.
Exactly, that slow financial drain. And then they cover the basic strategies for getting out of debt, like the avalanche method, where you focus on the highest interest debt first.
Which brings us to the more forward-looking part. Category 4, investing for beginners.
Yeah, and they really try to simplify it, which is key. They break down concepts like risk versus return and the absolute necessity of diversification.
And they spend a lot of time on the difference between, say, picking individual stocks versus buying an ETF.
An exchange-traded fund.
Mm-hmm.
And they stress ETFs for beginners for one huge reason: instant diversification. You're buying a tiny piece of hundreds of companies at once.
So you're not trying to find that one winning needle in a haystack.
You're just buying the whole haystack. It's just so much safer for someone starting out. So, okay, those first 4 categories cover the basics everyone needs. But what I find fascinating is how the framework then broadens out.
It moves beyond just managing your transactions.
Exactly. It puts it all in the context of a real life.
This is what makes it feel like a full curriculum.
Absolutely. So category 5, financial planning across life stages.
Yeah.
Now we're talking about real-world decisions. How do you plan for college? What do you need to know to buy your first home? How do you even start thinking about retirement?
It connects the mechanics to the milestones.
Then you get to category 6, wealth-building mindsets and habits. This part is all about flipping that get-rich-quick idea on its head.
It's build wealth slowly.
Build wealth over time, yeah. It's all about systematic habit, the power of compounding, and really truly understanding the time value of money.
Which is the perfect segue to the last one, category 7, financial education for families and kids. This is where we're going to dive in deep.
And it's such a key area. It's for any parent or caregiver who sees that gap in the school system and wants to fill it themselves.
All right, let's make that shift then. For anyone listening who is a parent or really just interested in how these foundational behaviors get built, this part of the framework is, well, it's brilliant.
It really is.
Despite all the complexity we just talked about, it all boils down to just 4 simple ideas: earning, saving, spending, and giving.
That's it. It's all about behavior, not complicated math. And for the really young kids, say ages 3 to 6, the goal is just one thing: awareness.
They're not calculating anything.
No, not at all. They're just starting to recognize that money is a real thing and that resources are, limited.
And the sources say they learn best from repetition and, crucially, visibility. You have to make money a visible concept.
You got it. The idea is to connect an action to a limit. It's not about saying no, it's about explaining a trade-off.
There's a great example they give about this.
Yeah, the grocery store example.
Yeah.
It's perfect. So instead of just saying, no, we can't get that, a parent can frame it as a choice.
A simple choice.
We're buying apples today, which means we're not buying cookies this time. It's so simple, but it teaches that fundamental lesson. A choice has a consequence. You can't have everything at once.
I mean, that's a lesson a lot of us are still learning when we look at our credit card statements.
We certainly are. And you can extend that to just daily routines, making the invisible visible. So instead of just paying the bills in secret, you can say something simple.
Like what?
Like, we pay for electricity so the lights turn on, or we pay the internet bill so we can watch our shows. It just connects money to the everyday fabric of life. It makes it normal, not scary or abstract.
And to make it even more real, they really push for the physical container method.
3 jars.
Yeah, 3 clear jars or piggy banks, 1 for saving, 1 for spending, and 1 for giving. It lets a child physically see where their money is going.
That visual is everything at that age. They see, okay, some can be used now, some is for later, and some is to share. It makes an abstract idea totally concrete.
So as they grow up a bit, say, into those elementary years 7 to 10, that awareness starts to become expectation.
Right. They start noticing patterns. That money comes in at regular times, and that sometimes you have to wait to buy something you want.
And the sources say this is the perfect window to introduce an allowance.
Yes. And the key philosophy here is that kids learn about money from repetition and, well, from having some responsibility.
Not from lectures.
Definitely not from lectures. An allowance gives them a safe space to practice, to make mistakes when the stakes are really, really low.
So the sources break down a few different ways to do this. First, you have the fixed allowance.
Just a set amount every week or every month. This is purely for practicing planning. Do I buy this small thing now, or do I save up for 4 weeks to get that bigger thing?
Then there's the earned allowance,
where the money is tied only to extra jobs, things that go beyond their normal family chores, like, washing the car or a big yard project.
So that teaches them that extra effort can generate extra income.
Exactly.
But I have to ask, the sources must address the risk here, right? The risk that your kid suddenly refuses to, say, clear the table unless they get paid.
Oh, that's a critical point. And yes, they do. They strongly caution against a purely earned system for basic family contributions.
So you have to draw a line.
A very clear line. There's family contribution, which is just what you do because you're part of the household. Unloading the dishwasher, keeping your room clean. That's unconditional.
And then there's income generating work.
That's the optional stuff. If you tie basic chores to money, you accidentally teach them that being a helpful member of the family is a paid gig. And that's not the lesson you want.
So for most families, the best approach is probably the third one, the hybrid system.
That's what's often recommended, yeah. A small base allowance for them to practice with, plus opportunities to earn more if they want to take on extra work. It's a balance of stability and initiative.
Okay, so as they get into those pre-teen years, maybe 11 to 14, their thinking gets more advanced.
A lot more advanced. They can start looking ahead, comparing different options. And this is when they can move from just thinking about one purchase to managing actual spending categories.
Like a mini budget for clothes or entertainment.
Exactly. And this is also the age where mistakes become the absolute best teacher. In fact, you almost want them to make small mistakes. Well, if a 12-year-old blows their entire month's allowance on the first day, the natural consequence is they have nothing for the next 29 days.
And that feeling of waiting is a much better lesson than a parent's warning.
Far better. It's tangible. It's real. You have to involve them in the risk for them to actually learn from it.
And beyond their own money, this is when parents can start showing them the bigger picture, the family's recurring costs.
Pulling back the curtain, yep. They need that system awareness. You might show them the electricity bill or explain the cost of the family cell phone plan.
It's not about making them worry.
Not at all. It's about helping them see the financial engine that's running in the background, the one they'll have to manage themselves one day. It makes the idea of bills real.
And that system awareness is the perfect setup for the teen years, ages 15 to 18. This is where financial education can shift into real-world practice, including investing.
Right. And the sources are very clear about this. The goal is not to chase big returns or pick the next hot stock.
Yeah.
The goal is to let them experience the power of one thing and one thing only: time. The lesson is about compound interest over decades.
That's a tough concept, though. Decades feel like an eternity to a teenager. How do you make that urgent?
The sources use a really powerful, really specific example. They use contrast.
Okay.
So imagine a 15-year-old invests just $100, a single $100 bill. They put it in a simple diversified fund and they just forget about it.
They never touch it.
Never touch it. With average market returns, by the time they're 65, that $100 could grow to several $1,000s just from time.
Wow. Okay. And the contrast.
The contrast is if that same person invests the exact same $100, but they wait until they're 30 to do it.
So they lost 15 years.
They lost 15 critical years of compounding. So that $100 will still grow, of course, but it will only be a fraction of what the teenager's investment became. The amount of money was identical. The only difference was time.
And that's a cost you can never get back.
You can't. It's a profound lesson that time and consistency matter way more than the initial amount you invest. It's about starting early, even if it's tiny.
So the goal is to let them see that process, not to get them day trading.
God, no. The idea is to use a supervised custodial account, put the money in a broad, low-cost fund, and just let it sit. The experience of seeing time do its work is maybe the most valuable financial lesson they could ever learn.
So wrapping this all up, what does this mean for you, whether you're teaching a child or even just trying to fix your own foundations? The sources point out some really common pitfalls.
Yeah, things that get in the way, like just avoiding talking about money altogether.
Or using it only as a reward or a punishment.
We're trying to introduce things that are way too complex, way too early. And the biggest one, just waiting for the right time to start.
Which, as we've just seen with that compounding example, is always right now.
It's always now. But the good news is these are all correctable, all of them. And when you look across this whole framework, the most effective systems all share a few key traits. One, money is discussed openly. No shame, no anxiety. Two, the rules are predictable. And three, the specific tool you use, jars, an app, whatever, it matters way less than the simple habit of conversation.
That consistency is the real engine of growth.
For any age. And if we connect this all back to the bigger picture, the benefits are just so clear. Kids who learn this stuff early, they just ask better questions later on, they feel less anxiety about money, and they bounce back faster from the mistakes they'll inevitably make.
So it all comes down to those 4 principles, really.
Yeah. Start earlier than you think you need to. Keep the system simple and visible. Allow for small, safe mistakes. And just gradually increase responsibility over time.
The sources make a really strong case that starting early doesn't guarantee you'll be wealthy.
No, but it guarantees something more valuable. A massive reduction in confusion when you face those huge high-stakes decisions later in life.
And confusion is what leads to bad decisions.
It's almost always the root cause. So we'll leave you with a final thought for your own life. What high-stakes decision are you facing right now? A new budget, an investment, a career change that would benefit from turning that complexity into familiarity, just by starting that conversation or that small practice a little bit earlier, like today.